today's topic over here, we'll be talking about technical analysis. So today over here, we'll be diving into the other forms of analysis called technical. Whenever we talk about this topic on technical analysis, there's just so many ways in which you can approach. There's so many strategies out there. For me, today, we'll be focusing more towards what we call the Elliott wave principles. So we don't really utilize in terms of like a lot of indicators. We look more towards how the market is moving, how the market is developing. We look at patterns to help us identify, like, should we focus on the buy? Should we focus on the sell? How are we going to execute trades, etc.? With that said, these are some of the objectives that we'd like to cover. First, of course, we're going to talk about the building blocks of TA, what builds up a chart, how can you look at a chart and start to differentiate the different movement, the different price development that's happening. And then, of course, we're going to introduce to you the key patterns that you want to be familiar with so that whenever you look at those patterns in the chart, when you start to identify them, it helps you to establish what we call a high probability direction. Okay, or in other words, we call this the directional bias. Okay, so if you're bullish on the directional bias, you focus on the buy trade. If you're bearish on it, you focus on the sell trade. And if you're neutral, which basically suggests that you just give time to the market, don't trade it at that time. And of course, a very quick one to introduce to you, who am I? So my name is Kar Yong. I started trading back in 2012. Since then until today, it's just about more than 10 years. And to me, 10 years in trading is not something like it's super long, right? I mean, there's so many other traders who have, more than 10 years of experience in it. But I just want to share with you that throughout my journey since June 2012, I've come across a lot of different techniques and methods, or even strategies, if you call it. And I just want to share with you that at the end of the day, okay, all of them has its advantages, all of them work to a certain extent. And as a trader, you do not want to just focus on the strategy itself, because there's just so many other elements that are equally important to help you become the trader that you want to be able to achieve that consistent result from the market. So over here, one of the biggest lessons that I've learned from the market is risk management. So no matter what method you use, what strategy you use, at the end of the day, risk management is super, super important. I learned it through blowing off an account, and I hope that by emphasizing that, you guys are able to avoid that painful lesson, right? You don't need to go through that painful lessons to learn the importance of risk management. I turned full-time by the end of 2015. So since then until now, other than trading and investing in the market myself, I also enjoy sharing what I've learned, what I've known with fellow traders. Today, that's what I'm doing. So that's a quick one about myself. Let's jump into the first part of today's topic, which is understanding the building blocks of technical analysis. The whole idea over here is whenever you look at a chart, any instruments that have a chart, they're basically drawing out the price movement, right? How market moves, how the price is developing, and doesn't really matter what time frame you're looking at. So it can be short time frames like 5 minutes, 15 minutes. It can be on intraday like H1 4-hour. It can be a long-term like daily or a weekly chart. The principle of technical analysis is the same. So whenever we look at a chart, right, the first most important thing that you want to be able to identify is the difference between an impulse move and a correction. So what exactly are they? Impulse moves are moves that what we call very fast and very strong momentum in the market, right? So if you look at a chart, essentially it's just moving very quickly. Just have an understanding of impulse equals strong momentum moves, strong movement within the market. So it can be in either direction. Okay, it can be a strong momentum to the upside, it can be strong momentum to the downside. We are not too particular of the direction as of now. What's more important is how the market is moving. If it's fast, if it's strong in momentum, that's impulses. So it basically means that the market moved in a particular direction in a relatively short period of time. So if you look at charts, what you can see over here, as this comes down, it came down very fast. Similarly here, this came down pretty fast. So those are what we call an impulse move. Of course, if you take a look at this move here, it goes up pretty fast. It goes up pretty fast. Those are impulses as well. Now, compared to what? Compared to relatively, if you take a look at this entire portion here, it's just not doing or not going very fast. There's no clear sense of direction as compared to this kind of move, right? What are fast moves? They are impulsive moves. So they can be going up, it can be coming down. As long as the market is moving fast, we categorize that as impulse. More example over here for you. Over here, you can see as well as the market came down, it was very fast, it went up equally fast. Both are impulses. Within this little move here, you can see small drop, small rally, small drop, small rally as well, small drop, small rally, right? So these are also impulses within it. So you have like a big impulse, and then within all this move here, we have a smaller impulse. So first, be very, very comfortable and be familiar with what we meant by impulse, okay? They're basically fast momentum moves. Over here as well, to give you more different examples of how it can look like. This is very fast. This is very fast, right? This went up pretty fast. This came down pretty fast. Those are impulses, okay? Of course, within it, these are slower moves, right? So if you compare in terms of relative terms, right, you can see what are fast move, what are slow moving development. So impulses are basically fast. Now in the market, if something is not moving fast, then the opposite, it's true, right? I mean, if it's not fast, then it should be slow. Okay? So if it's not an impulse, then naturally it will be a correction. So what are corrections? Corrections are basically slow moves in the market. And if you look at time, it's taking a longer time for it to develop. So it's not going anywhere. It's very slow. It's slightly in a range-bound environment. It's taking a very long time to develop. Those are the characteristics of a correction. So a correction can be sideways. It can be sloping a little bit to the upside. It can be sloping a little bit to the downside. But essentially, in a visual perspective, it's just slow. It's not going in any particular direction in a very fast momentum. We call them correction. So if you take a look at this example over here, those that have highlighted in gray, those are essentially your correction, right? So you can see here is up and down, up and down, up and down, but it's not really going anywhere. Here as well. And of course, this part here as well. When the market basically chops around and there's no clear sense of direction, those are what we categorize as corrections. So more example over here, you can see this as it's going up a little bit. It's very, very slow, right? So again, it's chopping around. It's a corrective move. Here as well, up, down, up, down, up, down. It's not going anywhere. So again, that's a correction. More example as well, you can see, okay, this is a correction. It's just not going anywhere. It's slow. Okay, it's taking some time to develop. Over here as well, it's taking some time to develop. It's not going anywhere in comparison to like this drop, right? So this drop is very fast. It's very clear. After that, this part here is not clear. So those are impulses and correction. Now at this point in time, just want to stress that some charts are going to be more obvious in helping you identify like what's an impulse, what's a correction. Some charts are a little bit more tricky, depending on your experience, of course. So my suggestion to you is if this is something fairly new, you find that you are very, very foreign to this concept of impulse and correction, then focus on those charts that are more obvious. And as you practice, the more you practice, the easier it gets, the clearer it gets to you. So again, it takes time. So don't rush things through, keep practicing. If you're new, as I mentioned, focus on the easier identify charts, which means very clear which are impulse, which are corrections. You will come across some charts that are just not clear. Then just skip those, right? Put them aside, look at other charts, come back in the future. So those are the basics of impulse and correction, which is very, very important. Maybe I'll just very quickly show you a chart, okay, to just illustrate, in the live context environment, what are some of the impulse and corrections that you can identify. This can be applied to any time frame, any particular asset, right? So for example purposes, we're just going to stick to 4 hour. Every time I look at a chart, the first thing I ask is what's happening on the right hand side. I always ask these questions. How is market developing, fast or slow? And I always start with the right hand side of the chart, because that's the most recent price pattern. If you look at the right hand side of this chart here and you ask yourself, right, how the market is developing, is it fast or is it slow? I think it's quite clear on this aspect here This is basically going up. Yes, there's a general sloping upwards move, but the move to the upside is slow, right? There's a lot of overlapping. It's not like going up in pushes of huge momentum. So I would safely say that this is slow. And what is fast? This is fast. That's impulse. This is a very corrective move. So fast and slow. So again, I want you to be able to very confidently identify that. Maybe some other example. Again, this is a dollar yen chart, right? So you look at the chart and you ask yourself on the right hand side, how is the market developing? I think this is again very obvious, right? It's going up, it's coming down, it's going up, it's coming down. It's just not going anywhere and it's taking a long time. That's a correction. Now, what's an impulse? This is an impulse, right? You can see it drops just very fast. A mini one here as well, it drops very fast. It drops here very fast. So those are impulses. If today you're looking at maybe commodities, it's the same thing. You want to ask yourself, right? How is the market developing here? Internally, you can see this is pretty fast. This is pretty fast. This is pretty fast. If you look from a 4-hour perspective as a whole, this is what we call a ding dong, right? It's not really going anywhere. It's sloping up a little bit, but it's slow. So this entire portion here, you can categorize that as a correction. Now, what's the fast move? This one here obviously is very fast, right? So those are what we call impulse versus correction. Good. So that's all from me. So this will be a very last webinar for the year. So I wish all the best for you guys. Have a happy holidays and I'll see you guys. Bye-bye.